In this video, we're going to be performing a deep dive on Caterpillar's dividend safety. To begin, let's talk about Caterpillar's business model. Caterpillar is the largest manufacturer of construction and mining equipment in the world. The company also supplies diesel engines and industrial gas turbines. Caterpillar was founded in 1925 and has a market cap of more than $75 billion with annual revenues of $55 billion. Caterpillar is a well-known dividend stock because of its compelling track record of dividend growth. The company has increased its dividend for the past 25 years. This means that Caterpillar is one of the newest members of the Dividend Aristocrats Index, a group of elite dividend stocks with more than 25 years of consecutive dividend increases. Looking ahead, investors interested in owning shares of Caterpillar will likely want to know the safety of future dividend payments. For the remainder of this video, we will discuss the company's current dividend safety from four perspectives. 1. Its dividend safety in the context of its current earnings. 2. Its dividend safety in the context of its current free cash flow. 3. Its dividend safety in the context of its recession performance. 4. Its dividend safety in the context of its current debt load. First, let's discuss Caterpillar's dividend safety in the context of the company's current earnings. When Caterpillar announced its fourth quarter financial results on January 28th, the company reported that it generated earnings per share of $11.20 for 2018. For context, Caterpillar paid $3.28 of common share dividends during the same time period for a dividend payout ratio of 29%. Using earnings, Caterpillar's dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. Accordingly, we will now compare Caterpillar's current dividend payment to its free cash flow. In 2018, Caterpillar generated $6.15 billion of cash from operating activities and spent $1.28 billion on capital expenditures for free cash flow of $4.87 billion. The company distributed $1.95 billion of common share dividends during the same time period for a free cash flow dividend payout ratio of 40%. Using free cash flow, our conclusion is the same as when we used earnings to measure Caterpillar's dividend safety. The company's dividend appears safe for the foreseeable future. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. Accordingly, this section will analyze Caterpillar's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by measuring its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Caterpillar's performance during this time period is shown here. Caterpillar's earnings per share declined by 75% peak to trough during the last recession, and dividends per share exceeded earnings per share in 2009. Fortunately, the company was able to quickly rebound the following year. Earnings per share have more than covered the dividend every year since, and Caterpillar was able to maintain its multi-decade streak of consecutive dividend increases. Looking back, investors may have found the company's dividend to be at risk in 2009. The fact that Caterpillar grew its dividend during this time gives us confidence that the dividend is a significant priority for the company's management team. Overall, we believe that Caterpillar would likely continue its dividend growth streak in the next recession. The last angle that we will use to assess Caterpillar's current dividend safety is by looking at the company's current debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before the company's free cash flow will no longer cover its dividend payment. Through the end of 2018, Caterpillar generated $404 million of interest expense and had $30.8 billion of debt outstanding for a weighted average interest rate of 1.3%. The following image shows how changes to Caterpillar's weighted average interest rate would impact the company's dividend coverage as measured by free cash flow. As the image shows, Caterpillar's weighted average interest rate would need to rise well above the 10% level before its dividend would no longer be covered by free cash flow. While we generally prefer companies to have a larger margin of safety for this metric, we believe that Caterpillar's debt level is unlikely to impact the safety of its dividend moving forward. Thank you for watching today's video, which performed a deep dive on Caterpillar's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.